2:47 a.m. Beijing time, an email hit the inboxes of China's biggest exporters. The message was short, just 4 words long: no more dollar payments. Effective immediately, all new transactions with US dollars were to stop. By sunrise, the impact was already being felt. US Treasury bond yields were climbing fast, Wall Street was on edge, and global markets were shaking. No warning, no threats, no press conference, just a quiet, surgical strike on the world's most powerful currency. And suddenly, one question was being whispered in every trading room from New York to London to Singapore. Is this how the dollar loses its throne? Not through war, but through silence. Beijing pulls the trigger. In April 2025, the Chinese Ministry of Commerce reportedly instructed more than 400 state-owned and private companies to halt all new transactions settled in US dollars. The leak, confirmed by the South China Morning Post, described the order as non-negotiable. This wasn't routine policy, it was a shockwave. Within 72 hours, Bloomberg reported that dollar-denominated trade settlement out of China had plunged 12.4%. ING analysts called it the clearest sign yet that Beijing isn't just talking about de-dollarization, it's making it official. China's yuan is no longer just riding momentum. It's being pushed forward by design. Its share in global trade finance jumped from 4.5% in 2023 to 7.6% by March 2025. And now, with the digital yuan being used to settle energy contracts, China isn't just trying to leave the dollar, it's trying to replace it. The market fallout. In the US, the impact was immediate and brutal. Within 48 hours, US Treasury yields spiked. The 10-year Treasury jumped 38 basis points to 5.09%, its highest level since before the 2008 financial crisis. JP Morgan reported that more than $212 billion worth of treasuries were dumped in just 4 trading days, much of it traced to sovereign wealth funds and major Asian investors. The People's Bank of China had already cut its US debt holdings from $859 billion in January to $729 billion by March. This move marked not a slow sell-off, but an acceleration. Mohamed El-Erian warned on CNBC that this shift could reset the global cost of money for decades. US bond market volatility hit levels not seen since the pandemic panic of March 2020. This wasn't random market noise. This was a message. If the dollar is used as a weapon, Beijing will treat it as a risk. The dollar's long decline. The dollar's share of global reserves has been falling quietly for over 20 years. According to IMF data, it's now just 57.2%, down from 71% in 2000. But this latest move by China may have tipped the balance. And it's not just China. Former IMF official Eswar Prasad told the Wall Street Journal that even some of US allies are starting to shift away from the dollar. The yuan's share in China's own cross-border trade settlements has now climbed to 48%. Overtaking the dollar for the first time in history. Adding to the pressure, Saudi Aramco confirmed its first full oil shipment to India settled in yuan on April 18th. Reserve currency status doesn't end with a loud announcement. It erodes one deal at a time, one transaction at a time. A new payment system. So what replaces the old system? SWIFT, the US-dominated payment network, moves over $5 trillion per day, but it's decades old, slow, and under US surveillance. Enter Project mBridge, a new system co-developed by China, the UAE, Thailand, and even the BIS Innovation Hub. In March, mBridge completed a real-world pilot, settling over $23 million in trades nearly instantly. No dollar, no SWIFT. HSBC Asia's head of digital infrastructure said mBridge shows that real-time cross-currency settlement without the dollar isn't just possible, it's about to become normal. Meanwhile, while the US is still debating whether to launch a digital dollar, China's digital yuan is already live, processing over $250 billion a year in payments at home and abroad. This is no longer a test run. It's working and scaling up. Washington's reaction. President Trump's response was fast and blunt. On April 19th, he posted on Truth Social, "Cut rates now, or we risk total collapse." Within hours, pressure mounted on the Federal Reserve to act. But cutting rates isn't no magic fix. It might calm markets in the short term, but sends a dangerous signal long term. The dollar index, which measures the dollar against other major currencies, plunged from 104.3 to 98.7 in just 5 days, the steepest weekly fall since 2009. Goldman Sachs estimated that $76 billion left U.S. markets in a single week, the fastest pace of capital flight in years. Lower rates might help loans and mortgages for a while, but they also make investors question the dollar's value. For the first time in 40 years, the dollar dropped against the yuan, the yen, and even the ruble. All at once, trade flows are shifting. The bigger picture is even more alarming for Washington. According to the IMF and the Lowy Institute's Global Diplomacy Index, as of early 2025, 128 countries now trade more with China than with the US. This list includes Germany, South Korea, the UAE, and even longtime allies like Australia and Chile. China's exports surged 8.9% year-over-year in Q1 2025. U.S. exports, meanwhile, fell 3.2%. Bloomberg notes that this isn't just about size, but speed. Beijing is signing trade deals across Asia, Africa, and Latin America at a rapid pace. The U.S., meanwhile, hasn't signed a major trade deal since 2020. The U.S. economy feels the pain. The U.S. economy is already slowing. The Commerce Department reported a 0.7% contraction in Q1 2025, the second quarter of negative growth. Real wages are down 2.1% from last year. Credit card defaults are at their highest since 2011, and small business bankruptcies have surged 18% year-over-year. Mortgage delinquencies just jumped 12% in a single month. Freddie Mac is warning of potential systemic stress in the housing market. Economists at Morgan Stanley now put the chance of a technical depression by year-end at 40%. The Fed faces a lose-lose decision: raise rates and crush housing, or cut them and crush the dollar. The bigger problem is Washington. China may have started this fire, but Washington may be pouring gasoline on it. In just the first 4 months of 2025, the U.S. has already run a $1.3 trillion deficit. Foreign central banks now hold only 38.6% of U.S. debt, down from 44.9% just 5 years ago. And it's not just rivals pulling back. Allies like Japan and Belgium have also cut their treasury holdings. Even Saudi Arabia reduced its U.S. debt exposure to a 9-year low. Economist Mohamed El-Arian summed it up: confidence isn't lost overnight. It's eroded by erratic fiscal management and weaponized policy. In other words, America didn't just wake up in a world with fewer buyers, it drove them away. The future. If China is cutting the dollar cord and the US is fraying it from the inside, who really controls the future of global finance? Because if the next step is a global shift away from holding US Treasuries as the main reserve asset, the impact won't just be felt on Wall Street. It will hit pensions, payrolls, and prices in every American household. And maybe this isn't even the final move. Maybe this is just China's opening gambit, and the real checkmate is still coming. So ask yourself, is the world preparing for life after the dollar, or is America writing its own financial obituary?